Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Frey Panayiotou, certified financial planning professional, the Cap in Capitalize. And on today's episode, we're taking a step back and getting into a beginner's guide to investing. What is investing? What types are available? How to get started? Things of that nature. But before we get into today's episode, as always, the free tip of the week. If you want to know what's going on in the world of money, act on your own eyes, not others' mouths. That's it. That's all I got. Okay. So we're now going to get into the beginner's guide of investing. And it's worth revisiting because, and I don't know what is in the air, but recently people have been getting too far ahead of themselves when it comes to personal finances. And I partially understand it because investing, it can be fun. It can be exciting. Dare I say it could be sexy, but it doesn't need to be. And people are getting carried away. So we need to bring it back to basics. However, for today's episode, I want to lay out the outline because even though this is considered a beginner's guide, investing in itself is elaborate. And with that understanding, we're going to get into the intro levels of discussions with investing, but it has to be elaborate if you want to be successful in this endeavor. And so for those of you that are new to the channel, I welcome you. And this is going to be literally a beginner's guide to investing, but it's going to be more detailed than most beginner's guides out there, which is going to be helpful for you in the long run, but you are going to have to work at it. And for those of you that are coming back to the episode, or excuse me, coming back to the channel and in the podcast, welcome back. And you may have heard some of these things before, but I can almost, not completely, but I can almost guarantee that you're going to learn a thing or two, or maybe 16 during today's episode. So let's get into the outline of how we're going to tackle today's episode. First off, we're going to get into what investing is, technically speaking. Then we're going to get into what types of investments are out there. Third, we're going to get into how to know what's right for you. And then I'm going to give you a bonus on the tax conscious side of things when it comes to investing, because people forget, and I've said this many times before, but I will say it again. I'll probably say it a million times more. The best investment that you can guarantee, other than investing in yourself, is not an actual investment. It's the taxes you don't pay. And understanding tax consciously how certain investments work is going to be mission critical for you in the long run. So let's get the easy one out of the way. What is investing? According to Investopedia.com, this is their definition. Investing is for the long term, usually years or decades. Investing is one of the key strategies to building long-term wealth and financial security. I actually don't agree with this completely, as there's actual validity to investing for short-term goals and needs to maximize the return in which you will earn given the amount of risk you are taking. Within that time frame, you need the money back. But I do want you to know as well, and I'm more elaborating on Investopedia's definition. You need to know that investments will come and go, but the first thing that you need to do before you even think about investing is you need to lay out a concrete plan, a financial plan, as the plan will dictate how you need to invest. And then once you understand this, Then you can open up each part of your plan. And based on the different types of investments within that part of your plan, you can select what is most appropriate to you. Now, I know I went through a lot just then, so if you need to rewind that a couple times to really let it sink in, do so. Because if you can get this to click in your mind, you will be ahead of probably 100% of your peers. Now, the second thing we're going to get into, what types of investments are out there? And this is going to be a pretty good size of our episode today. And I thought about this, and before I even wrote the episode, I thought, okay, how am I going to do this? Because there's so many different types of monies out there. And what I think is going to be most valuable for you is to break down different investments based on different timelines. And I want to briefly go over those types of timelines. The first one is what I'd consider immediate monies. And that means within 7 years of when you need the money. Intermediate monies would be number 2, and that's anywhere between 7 to 15 years. Long-term monies, which is 15 years and above. And then alternative investments. But before I get into all of those, there's one type of money that I don't mention when it comes to investing, and this is for pre-retirees and retirees, which is lifetime income. And this generally falls into using permanent life insurance, such as whole life is probably the most commonly known, but there's a boatload of them out there. I'm not going to get into the weeds of it today because it's beyond the scope of our episode. But the purpose of permanent life insurance is there's a death benefit, but there's also cash value. So you can use an argument for utilizing cash value as a tax efficient retirement vehicle when you're in retirement. You can take loans against it to help supplement retirement income. There's a variety of things you can use permanent life insurance for. Or another thing that falls under lifetime income is a lifetime income annuity. Generally, that falls under the category of something called a fixed index annuity or a variable annuity. Technically speaking, and this is under compliance and regulation, variable annuities are considered investments. But for the purpose of today's episode, I don't want to consider those 3 strategies I mentioned as much as I consider them. I don't want to consider them investments as much as I want to consider them longevity plays and alternative forms of pensions. So because of today's episode being on investing, I just want to leave it at that. So let's get into immediate monies. So what are immediate monies? Some of them are pretty obvious. Cash. If you need something immediately, you need to have cash. Savings, whether it's at your bank or an online bank. A money market account. CDs. Bonds. There's a type of annuity called a fixed annuity. So I just want to explain how all these work in basic terms. I really don't think I need to explain how cash works. Pretty straightforward. I don't need to explain how savings works. Money market accounts, you could argue, are like savings, except they can potentially earn a higher yield and they are liquid. And those are banking tools. CDs, all things being equal, generally earn slightly more than a money market, but there's a give and take there. Generally speaking, with CDs, you have to lock your money up for that certain period of time. Now, it's pretty easy to get your money in and out of a CD. The penalty is missing out on the interest you otherwise would have earned if you held it to maturity. But keeping it simple, that is what a CD is. And a bond, again, you're all things being equal, probably going to earn a higher return than a CD, but you are taking risks with that because that is some form of loan, whether it's to the government, whether it's to a piece of real estate. It's an IOU, essentially. It could be to a business. That is what a bond is. So you lend the money out. So let's say it's $100,000. You lend that out. You get your money back after that period of time. But whatever that coupon is, that is what you are going to earn on your investment. And one real quick thing with bonds is they are interest rate sensitive. So generally how bonds work is if you buy it and then it comes back to you and you don't choose on selling it in between that period of time, you're going to get your return, which is the coupon in which it's paying. So if it's a 4% bond coupon rate, you're earning 4% on that bond. It's pretty cut and dry. However, bonds are attached to interest rates. So when interest rates rise, and they're attached inversely. So if interest rates rise, bond prices generally decrease. But on the flip side, if interest rates decrease, bond prices usually rise. So you can get a little creative with bonds if you'd like. And then fixed annuities are pretty cut and dry. You put your money in it. It is contractually guaranteed by the company in which is providing it. So I guess you could say the guarantee is only as good as the company in which it is being provided from. However, you are contractually guaranteed to earn whatever that fixed rate of return is over the period of time in which the annuity is purchased. And generally speaking, if you buy a fixed annuity, you're holding it for either 3 years, 5 years, occasionally 7, in seldom 10 years. But what I want you to understand is the longer you hold that annuity, you should be earning a higher return because this is an illiquid investment. So that's basically all you need to know about the immediate monies out there. In terms of intermediate monies, so money that you would need in anywhere between 7 to 15 years, I'm going to go through them and then I'm going to explain them all. Balanced funds, where you invest in bonds as well as stocks. There's something called a preferred stock, where a business basically lends out money, but it's not a loan. It's just another layer to a business. So debt gets paid first, then preferred stockholders, then common stockholders, which is what you would think on the stock market. So they get anything that's left over. There's something called an equity index annuity. There's something called a RILA, a registered indexed linked annuity. And technically speaking, and again, I got to put this in here due to compliance, variable annuities could be included here. So what is a balanced fund? Going back to that. Theoretically, balanced funds are where you invest in higher risk bonds and lower risk stocks. And I'm putting that in quotations. There's definitely some, I can see the validity when people say that there's something known as a higher risk bond, because if you're lending out to a business that is not as financially sound, that's more risky. So you should earn theoretically a higher return on your investment. But as far as more conservative stocks, there's no such thing as that. And I know I'm going to get a lot of slack from people in our industry with that. Not that I care, but a stock is a stock, period. Now, there are companies that underlyingly may be more risky than others, but that gets way too into the weeds of it. And again, this is a beginner's guide to investing, not, investing like Warren Buffett. A preferred stock, generally speaking, because you're getting paid after debt, you're going to earn a higher return than debt holders. So if let's say that, I'm just going to make it really easy. Let's say that you buy an apartment complex and there's 3 types of debt, or there's 3 types of owners. There's debt holders, so like the bank, preferred stockholders, and common stockholders. Well, the debt is going to get paid first to the bank, and the bank isn't going to earn as high of a return, but they're the first to get paid, so they're not taking as much risk. Once the debt holder is paid, the preferred stockholder has to get paid their return. And generally, this is a fixed rate of return. And it is going to be, on average, higher than a type of debt because they're next in line. So let's say that a bank is getting paid at 4%. A preferred stockholder would probably be earning around the 6 to 7%, assuming there's the spread there. And then anything left over gets paid to the actual owners of the property or the business. Equity indexed annuities, EIAs, actually a pretty straightforward investment strategy. So you put your money in it. And again, they are contractually guaranteed by the insurance company that is providing these annuities. So whatever you put it, you buy it, You can't go backwards. Now, generally speaking, and it's titled within the description is within the title, equity indexed annuities. Generally, the underlying investment is tied to some type of index, like a stock market index. And so let's say that index goes up between 0 and whatever the ceiling is that these equity indexed annuities provided. Well, you're going to earn that return, and then it locks that in. Now, if the equity index annuity hypothetically had a cap rate of 6%, so the market goes between 0 and 6%, that's what the equity index annuity is going to earn for that year. Well, let's say the market was up like 30%. That's a lot more than 6. So the insurance company would eat that remaining 24%, because they're the one carrying all the risk to make sure that they pay you that guaranteed rate at the very end of the term. And you're probably thinking, well, that's a really bad deal for me. It sounds like it on the surface, but let's say that the next year the market takes a big dip. You just stay where you're at. If the market has a rebound, you continue where you left off. So again, not getting too much into the weeds of it, but that is what an index annuity is. That's where it can become immensely valuable for intermediate types of monies. I see this a lot in my practice where, let's say someone wants to retire in 5 years and they can't just sit on their behind and not earn anything, but they also can't risk a certain amount of money and just go bonkers for the long term. That's where an equity index annuity could become incredibly valuable. Now, RILAs, registered indexed linked annuities, have become massively popular over the last couple of years. However, they've been around for a very long time, and Wall Street does an amazing job of retitling things that have been around for a while. Back in the day, these were referred to, and they can still be referred to today, as structured annuities. So it works very similar to an equity index annuity. However, you can lose money on them, but you, generally speaking, have some type of a buffer. So on the flip side of that, if you could technically lose some money, you can also make a little bit more than an equity index annuity, all things being equal. So it comes down to understanding with intermediate types of monies, how much are you willing to earn versus how much are you willing to risk? And there's a true risk reward perspective on it. And again, variable annuities, due to compliance, they would be included in this, but I'm going to keep it simple and move on, because that's going to mud the waters here. This also brings up a point, and unfortunately, a lot of advisors and planners in our industry don't understand this. And so if you're an advisor or planner listening into this, listen up. And for everyday people, listen up as well. Different types of investments that I'm laying out actually shift over time due to the environment. And what I mean by that, saying it another way, is there are certain investment strategies that may be considered immediate monies, but because their rate of return is considered higher than historically normal, you can make an argument that immediate monies could in fact be used for intermediate types of monies. And so once you understand that, my point with that is, don't get fixed on which type of money fits within certain periods. Stay nimble. Stay very nimble when it comes to understanding these types of monies and how these work. Now, in terms of long-term monies, this is pretty cut and dry. When I think of long-term, and when you think of long-term money, 15 plus years or more, I want you to think of the stock market. And there's tons of data as to why I say this. It's in my first book, Capitalize Your Finances, a couple times, but I'll say it again. Since 1950, there has never been a 15-year rolling period where the market has had a negative return, and the average return over that period of time is around 8%. Now, when I'm actually writing plans for clients, I bring that return down slightly, because I want to be conscious of taxes and I just want to have a margin of safety and be more conservative. But the point is long-term monies, you're trying to think 15 plus years of attempting to earn somewhere between that 6 to 8% range, depending on your level of sophistication and confidence when it comes to investing. Hopefully you earn gobs more, but you got to be realistic when it comes to your plan. Now, in terms of the stock market, there are three main areas I want you to think of, or three main types of investments out there. There's mutual funds, there's ETFs, or a lot of people refer to them as index funds, and then there's individual stocks, individual companies. And in terms of how all of them work, the stocks is pretty straightforward. You analyze a business, you think it's a great business, and you buy the stock, which is a fractional piece of ownership in that business. An ETF, slightly more complex, but not tremendously. You are buying a benchmark, and it's the whole adage of if you can't beat them, join them. And the most commonly known and understood is the S&P 500, which is the top 500 companies in the United States. And you would buy this S&P 500 index fund, which is a basket of those types of companies. Now, there's a multitude of other options out there. You could invest in a total world fund, index fund. You could invest in something called the MSCI, which is everything but the United States. There's something called the Russell 2000, where you invest in 2,000 of something considered small cap companies, smaller companies. But the point is index funds can be an easy way for you to theoretically set it and forget it. And I say theoretically because, and I want to caution you, just because an index has done well over the relatively short period of time does not mean it will continue to do so. And that's more than saying past performance doesn't guarantee future returns, which is what I'm required to say in our industry. And there is merit to that. You need to be a history buff when it comes to this too. A lot of people totally forget, and then I'll get into mutual funds here. It's a little bit of a tangent, but it does relate. So lately, I'd say over the last 10, even 15 years, people have said, man, you invest in an S&P 500 index fund, you're going to be fine. That's all you need to do. Lately, that's been true, but people also forget about the most popular index fund that people looked at back in the 80s, 90s, and even early 2000s. And it was not the S&P 500. It was the Nikkei index, the Japanese index. And the reason for that was in the 80s, 90s, and up into the very early 2000s, before Japan's market just absolutely cratered, you could do no harm. Their stock market was crushing it. Their real estate was crushing it. People were buying things at an ungodly multiple that was just asinine. And then what happened? Right after Y2K, up until very recently, the Nikkei, the Japanese index, if you will, it's gone nowhere for almost exactly 25 years. So you got to be really cognizant and aware of, I'll just invest in an index fund and you're going to be fine. Not true. You got to be a little bit more on top of it than that. Mutual funds. So let's say that you know some type of investor that is a manager of a particular fund, and you agree with his or her understanding and philosophy of investing, or in some cases, there's a team of people on it. And you understand all of it, but you don't want to get into the weeds of managing individual investments. That's where a mutual fund would come into play. And I want to note something here. It really doesn't matter which strategy you use, whether it's mutual funds, ETFs, or individual stocks. The point is, you're in the stock market for the long haul. That's the big ticket item. And then you can select based on behaviorally what draws you in most according to who you are. And secondarily, then you're getting custom according to, your temperament when it comes to investing. And then there's alternatives. And this is going to be the last one we talk about before the commercial break. And I've given a lot. I've thrown a lot at you. I'm about to throw a heck of a lot more at you. This could be an episode where you have to go and re-listen to it 2, 3, 4 times. That is okay. That is okay, because investing, it's an inch deep, but it's a mile wide. So as you go along the mile, you're just chipping off little snippets of information, and you're just compounding your knowledge at a rapid rate. So back to alternatives. So what are they, and what are the most common alternatives out there? Because there is a mountain of options when it comes to alternatives. And some of them I'm not really even allowed to discuss due to compliance, but I'm briefly going to just state them and move on, so compliance people don't freak out. There's real estate. That's probably the most commonly known and easy to understand alternative out there. There's BDCs, which stands for business development companies, which are similar to bonds, but they are a little bit riskier. There is cryptocurrency, but again, due to compliance, I can't elaborate beyond that. Just simply, I'm mentioning it. Private equity, so privately owned businesses. Venture capital is a one-off of private equity, except it's more risky because you're getting in earlier. There's something called an interval fund, hedge funds, and commodities. And again, there are plenty of other alternatives out there, but this is a wonderful starter pack for you to understand what types of alternatives are out there. I really don't think I need to explain what real estate is, whether you invest in multifamily apartments or a commercial building or a warehouse or self-store. It doesn't matter. Real estate's real estate. You earn some income. It also grows over time. It is an alternative way to earn an income as opposed to the immediate monies I talked about. And it's an alternative way to grow your net worth as opposed to the traditional form of growth, which is the stock market. As far as returns that people, and I'm not guaranteeing anything here, but as a broad brush, real estate is earning anywhere from 4 to 5% on the income side of things. And conservatively, I want you to budget in anywhere from 3 to 4% growth. That comes from, it's actually in my office. It's called The Big Picture. And I believe it was from 1929 to 2019, the average home price appreciated at around 4% a year. And so that's where I'm going off of it. Okay. I hope you earn more. And recently people have earned much more, but I'm not going to get into theories as to why that's good, bad, or indifferent. Business development companies, you're not really going to earn anything on the growth side of things because, again, it's no different than a bond. However, business development companies, what they do is they lend to these businesses because banks aren't lending as much anymore. And because it's definitely a riskier asset and it is a riskier investment, you are theoretically earning a higher return for that. And so generally speaking, BDCs are used for income, whether it's in retirement or to replace bonds within your portfolio. And as of today, the average business development company, if they're lending to businesses with floating rate loans, which are tied to interest rates, you're generally earning anywhere from the 9 to 10% range. But again, there's no growth to that, and there is risk with that. Private equity, privately owned businesses, those are illiquid assets. All alternatives are illiquid assets. You want to think of them as such. You want to invest knowing that that money is going to be tied up for a very long period of time. So private equity, when you're investing in privately owned businesses, there is going to be risk with that. It's not like a stock where you can just get out of it any day, any second, basically, when the market is open. And so private equity, they are theoretically trying to earn a higher return for you. There's a wonderful book out there called How to Invest by Dave Rubenstein. I've mentioned it a couple times on my show before. And Dave Rubenstein, who's one of the founders of Carlyle Capital, a private equity firm out of Washington, D.C., he interviewed some of the best investors in different types of investments out there. So real estate, stock market, private equity, et cetera. And private equity investors, on average, attempt to earn, this is what they say they try to earn you, anywhere between 12 to 15%. That is by no means a guarantee. Compliance people before you shoot me in the foot. That's Dave Rubenstein's quote. It's not mine. I always throw a margin of safety on that because it's one thing for people to say that. It's another thing to see what actually happens when you include taxes and all of that. So for private equity, if I were you, I would love for you to earn 12 to 15%, but lower that expectation a little bit. However, lowering that expectation to say around 10 to 12, you should be pretty happy with that. I don't know anyone that would be ticked off. And if someone is ticked off with that, then they've got other issues. Venture capital, you're getting into businesses even earlier. So again, it's private equity squared, if you will. And with venture capital, they attempt to earn anywhere, well, in the mid to high teens. But again, you're taking an obscene amount of risk on average relative to private equity as well as the stock market. Interval funds can get a little squirrely. I'm not against them at all, but interval funds are kind of like mutual funds. In fact, they look like mutual funds, but unlike a mutual fund where you have to invest in traditional investments like a stock or a bond or CDs, whatever, in mutual funds have a lot of have to do's. Like you have to keep 10% of the portfolio in cash. You have to distribute 90% of your income every single year. There's a lot of have to's. With interval funds, it's kind of the Wild West. I mean, you could invest in stocks and bonds, you can invest in private equity, you can invest in real estate, business development companies, crypto, you could take leverage on it. I mean, you could get really creative, but what I've seen interval funds, the most successful ones do is they basically provide some type of liquidity, even though they are illiquid, some type of liquidity to an otherwise illiquid asset. That's as deep as I'm going to go. Hedge funds, frankly, 99.99% of the time, I haven't been a huge fan of them. Hedge funds are a way for you to invest in strategies that, and it's kind of within the title, hedge your bets against other investments within your portfolio. I'm just not a fan of them in general, just because of the fee structure, traditionally speaking. That being said, I've even interviewed some of my favorite investors in the world are hedge fund managers, and they've aligned their hedge funds accordingly from a fee standpoint. But all you need to know is hedge funds, what they do. It's kind of within the title. And then commodities are pretty cut and dry. That's gold, silver, timber, oil, gas, copper. These are things that you could buy and then turn around and produce them or make them into something. But that's all I'm going to get into with that. But as far as now knowing what all types of investments are out there, you now know all of that. So we're going to take a quick commercial break. You're going to go get a sip of water or coffee or something, maybe take a walk because this was a lot. And then when we come back, we're going to get into how to know what type of investment is right for you. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We're going to get right into it. I know we went over a lot and we're going to go over even more, but this is going to be the most valuable beginner's guide to investing that you have ever heard on the internet, with absolutely zero bias behind that statement. So let's get into how to know what's right for you. Because again, before the commercial break, I went through all of these types of investments. Now we need to get into you understanding what is right for you. Because this is the beginner's guide to investing, I'm gonna give you some pause. I won't dive too deep. I could, but I won't. What you need to know is that it's gonna come down to you figuring yourself out. And you're probably thinking, man, Chris, I listened to the first part of this episode and you're going to give me the keys to the castle and that's the answer. I got to figure myself out. Hear me out for a second. Let's just take the stock market as an example. Some of you, for whatever reason, and it's not better or worse, it just is. Some of you will be more drawn to index funds or ETFs. Some of you are going to be more drawn to mutual funds, or within your retirement plan, maybe that's all you have access to. Okay, we'll work with what the cards you're dealt with. And the reason for that is you may look up an investment and you look into a mutual fund manager and that mutual fund manager speaks your language. Others you may be more inclined to dive into individual companies. The point is this, though. Once you know that you need X amount of dollars invested in your long-term portion of your plan, here's the beauty of what we just went over the last however long this episode's been going. Whatever strategy within that portion of your plan you choose, because the plan is correctly aligned, whatever you select inside that portion of your plan is secondary and matches behaviorally what aligns with you the most. Because what did I say at the very beginning of this episode? Investments will come and go, but as long as strategically you understand what you need to do from a planning perspective, the plan will dictate how you need to invest your money accordingly. And I could extrapolate this through every type of money within your plan. Let's say that you need alternative exposure based on what your plan says. And maybe you just don't understand private equity. I'm making this up on the fly. Great. Then don't use it. Maybe you from a tolerance standpoint or an understanding standpoint, you can't stomach it. Great. Maybe you don't understand business development companies. Great. Maybe for whatever reason, you just don't understand real estate. But private equity, it's your jam. You're vibing with it. Great. Go with that. It still fits within the alternative space. Intermediate monies. Let's say that you need liquidity. It's your thing. You don't want to lock money up into an equity index annuity or a RILA or even a variable or a preferred stock. Well, balanced funds are probably going to be your ticket then. Let's say that you understand the risk reward perspective of things and you want to protect some of your downside. Well, then a RILA might be the option for you. Like I could customize that to the studs, but it doesn't really matter from a selection of investment perspective as long as the plan works out. And that's overly simplified, and we'll get into that in point 4 with tax consciousness. Go into the immediate side of monies. Well, if you want to keep it really simple, have your emergency fund plus a couple years of runway in an online savings account. It's liquid, not paying anything for it. Fantastic. Let's say that you're trying to theoretically earn a higher return and you're wanting to risk some of that immediate monies and you get it. So after your emergency fund with your savings account, you've got your cash in your cash. Maybe you've got some money market exposure to earn a little bit higher return on your liquid money. Maybe the rest of it, you're laddering bonds or fixed annuities. Maybe there are other options that I didn't get into today, but that are a little bit more sophisticated. And the reason why I didn't say it is this is a beginner's guide of investing, but maybe you take whatever's left over and you invest in those types of strategies. It doesn't really matter. It doesn't really matter because the plan will dictate what you need to do. And all you need to do is after the plan has been put in place, you just figure out what feels more comfortable with you. And that's the beauty. It's still going to work for you. Assuming, you don't invest in like a Ponzi scheme or something like that. Now, the fourth part of today's episode, and this is the bonus, tax consciousness. I said it at the beginning. I will say it again. The greatest investment you can guarantee other than in yourself is not an investment, it's the taxes you don't pay. This is mission critical. If you have money in a retirement account, so your 401k or an IRA, or even Roth 401k or Roth IRA, taxes in terms of investing, for the most part, it's not nearly as complex because you get taxed when the money is pulled out of retirement accounts when you're in retirement, if you have a 401k or IRA. But if it's a Roth, tax-free. That simple. So within the actual accounts, it doesn't really matter tax efficiently how you invest that money. But when it comes to a taxable account, a non-retirement account, or I call it a naked account because there are tax consequences. You're not shielded from the tax consequences of investing like you would be within a retirement plan or an individual retirement account. When it comes to taxable accounts, naked accounts, especially if you are in a high tax bracket and you have a high net worth, it definitely matters what you select. And without diving too deep, I'm going to give you a brief example with alternative investments. So some investments pay a higher income, like a BDC, but those incomes are taxed at ordinary income rates. So like your W-2 wage. Real estate, on the other hand, is traditionally taxed more efficiently with return of capital, Section 199A, which is some of it's tax-free, depreciated income, which is deferred until eventually you sell it, but that's not taxed at that time. And return on capital is tax-free. So calculating the tax equivalent income, if you are going to use alternatives in a taxable account, is a practice worth mentioning. Because if you're earning 10% on a BDC, but it's all ordinary income and you're in the 35% tax bracket, well, your tax equivalent income is not 10%. It's about 6.5%. On the flip side, let's say that you are earning 5% on a real estate investment, but you're not taxed on any of that income. So from a tax equivalency, you take 5% times 1 point, whatever your tax bracket is, 35%. And when you do the math on that, you're earning about the same, if not maybe slightly more than a BDC from a tax equivalent standpoint, but you're also going to get growth from the real estate. You're not really getting any growth traditionally from a BDC. So that's just a sliver of how you need to think operationally about where do you invest your money within a taxable account versus a retirement account. Now, I know I've covered a ton in this episode. The purpose of today's episode is to get your beginner investing minds to think. I need you to start thinking. And not just a little bit. I really wanted you, by the end of this episode, for your engine to rev harder than it's ever revved in its life. If you invest on your own, this episode now gives you guidance on really everything that is out there, or practically everything. And you don't need everything. You really don't need everything. But I wanted to lay as many tools out there that I see in my practice day to day. If you work with someone or are planning to, make sure that you have an open discussion with your certified financial planner on all of these things that I mentioned. As most planners and advisors stick to maybe 1, 2, they're a 1 to 2 trick pony. And frankly, this industry needs to do better. So by having you, the consumer, ask all of these questions, my industry, which needs an elevation, it can't help but elevate itself. So that does it for today's episode of Capitalize Your Finances on a beginner's guide to investing and what it is and how to go about it. At this point, you know how to get a hold of me, and we'll roll it through the end of the episode with the rollout. So as always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap in Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Frey-Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Investments in real estate may be subject to a higher degree of market risk because of concentration in a specific industry, sector, or geographical sector. Other risks can include, but are not limited to, declines in the value of real estate, potential illiquidity, risks related to general and economic conditions, stage of development, and defaults by borrowers. Annuity protection guarantees are based on the claims paying ability of the issuing insurance company. Stock investing includes risk, including fluctuating prices and loss of principal. No stock investment strategy or risk management technique can guarantee return or eliminate risk in all market environments. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxable as ordinary income upon withdrawal. Guarantees are based on the claims-paying ability of the issuing company. Withdrawals made prior to age 59.5 are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. You should carefully consider the investment objectives, risks, charges, and expenses of a non-traded BDC before investing. The prospectus, which contains this and other important information, can be obtained from your financial advisor or the issuer directly. You should read it carefully before investing or sending money. Investing in mutual funds involves risk, including possible loss of principal. Fund value will fluctuate with market conditions and it may not achieve its investment objective. An investment in exchange-traded funds, structured as a mutual fund or unit investment trust, involves the risk of losing money. An investment in ETFs involves additional risks such as non-diversification, price volatility, competitive industry pressure, international political and economic developments, possible trading halts, and index tracking error. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Preferred stocks are sensitive to interest rates. The share price generally falls as prevailing interest rates increase. Other risks include perpetual life or very long maturity, a call feature, low credit standing, deferrable dividends, and for traditional preferred stocks, depressed yield due to demand from corporations that receive favorable tax treatment. The details of each preferred stock depend on the issue. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. The MSCI All Country World Index ACWI is a stock index designed to track broad global equity market performance. Maintained by Morgan Stanley Capital International, the index comprises the stocks of nearly 3,000 companies from 23 developed countries and 24 emerging markets as of December 29, 2023. Russell 2000, the index measures the performance of the small cap segment of the U.S. equity universe. It is a subset of the Russell 3000 and includes approximately 2,000 of the smallest securities based on a combination of their market cap and current index membership. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Distributions of principal from a Roth 401k are tax-free. Any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Christopher Panayiotou is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. LPL Financial California Insurance License Number 0518721. LPLIA California Insurance License Number 0B91442.